Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue our webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. Before I introduce today's presenters, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of this week. And if you have any questions, feel free to enter them into the lower right-hand side of your interface under the Q&A bar, and our presenters will try their best to get to them all. Now, join me in welcoming back our friend, Erin Kerrigan, Managing Director of Kerrigan Advisors, which she founded in 2014, and Ryan Kerrigan, Managing Director. For those who don't already know, Kerrigan Advisors is the leading sell-side advisor and thought partner to auto dealers across the U.S. Now, I'll stop talking and leave it to the pros, so take it away, guys.
Thank you, Rachel, and thank you, AIADA, for inviting Ryan Kerrigan and I to discuss the coronavirus's effect on the buy-sell market and blue sky valuations. We're also excited to review our most recent blue sky report, which we published last week on June 8th, and that covers the first quarter's buy-sell activity and 2020 trends that we are seeing. For those who do not have a full copy of the report, please do feel free to email me at erin@kerriganadvisors.com, and I am happy to send one directly to you. Before we get started, we want to communicate that our firm is here to assist you with your critical business decisions during this historic period in our industry's history. Please consider Kerrigan Advisors a confidential thought partner to assess your current and future plans, whether that is for growth, raising capital, or selling your valuable dealerships. We look forward to speaking with you about our nationally recognized sell-side services, capital raising capabilities, and consulting practice. And with that brief intro, let's get started on the material at hand. It is really hard to believe that just a few months ago, on February 16th, most of our industry was at NADA in Las Vegas, not practicing social distancing. Rather, we were reveling in 2020's incredible start to the year. After all, industry earnings through February were up 38% as compared to 2019, and we were on our way to 2015's peak level. At least that's what we thought at Kerrigan Advisors. This, by the way, was pretty incredible when you think about it, because actually new vehicle sales were relatively flat through February, but our industry continued to prove its ability to grow earnings with high margin service and parts revenue, strong F&I income, and rising used unit sales. Not surprisingly, deal making was also in full throttle at the beginning of the year. It was palpable at NADA, with dealership valuations approaching record levels. And the Kerrigan Index told a similar story. Our proprietary index of the 7 publicly traded auto retailers was up 42% from January 2019 to February 2020, with many of the composite companies hitting their all-time record valuations, including Group 1, Asbury, Lithia, and CarMax. In fact, the index was only 7% below its all-time high. With rising profits and valuations, most expected 2020 to be a record year for acquisition spending, particularly for the publics. Asbury had already announced a $1 billion deal that was supposed to close in the first quarter, and many felt it was inevitable that we would approach 2015's peak acquisition spending levels. But of course, that inevitability abruptly came to an end in mid-March, just 30 days after NADA, when the World Health Organization named the coronavirus a global pandemic, and stay-at-home orders swept across the country, including Las Vegas, which unimaginably to most closed the entire strip just 30 days after the convention. COVID-19 shocked the entire economy, especially auto retail. With showrooms shuttered for the first time, auto sales and service plummeted. Average dealership earnings declined 65% in March, and the industry reported its first monthly loss since NADA started publishing the data, and that was, of course, in April. And with the virus spreading throughout the country, the economy in turmoil, Wall Street panicked. The Kerrigan index dropped 54% between February 20th and March 18th to levels not seen since 2012. Investors were deeply concerned about the dramatic contraction in auto retail sales and the economy's ability to recover. And of course, with the public stock prices down so significantly, their valuation multiples also followed suit. At the end of the first quarter, the public's average blue sky multiple had declined to just 2.8 times, and that's from 6.2 times that it traded at the end of 2019. This made most attractive acquisitions dilutive to earnings and resulted in a major reduction in their spending expectations for the year. In fact, instead of completing $1 billion worth of transactions in the first quarter, the public spent just $135 million. And of course, most of that was spent before COVID-19 came into effect. That's an 87% decline from their projected spending levels. Kerrigan advisors found that the buy-sell market really did go into a complete standstill starting in mid-March. Both private and public transactions were either postponed, renegotiated, or in the worst case, terminated. In the case of Asbury's billion-dollar acquisition of Park Place dealerships, sadly, that record deal ended on March 24th, with Asbury's market cap down 50% from when they announced the acquisition to the same level, quite incredibly, to the same level as the purchase price for Park Place. That deal became very difficult for the company to close. By the end of the first quarter, total industry transactions had declined 9.3%, with expectations that the second quarter would be much worse. Keep in mind that our transactions usually have a long lead time, primarily due to OEM approvals. So when dramatic events such as the coronavirus occur, we often see a decline in activity about 3 to 6 months out. As such, we expect the second quarter of 2020 to be one of the lowest buy-sell quarters in recent years. But as challenging as the auto retail market has been and was at the end of the first quarter, there are reasons for optimism about the industry's resilience in the face of a crisis, particularly when looking back at recent history. It is important to remember that in the depths of the Great Recession, auto retailers remained profitable despite a 50% decline in new vehicle sales. Most critically, in our view, auto sales led the U.S. economy out of the Great Recession, outperforming total retail sales by 35% during the 5-year period after the crisis. And dealership earnings rose at an impressive 30% compounded annual growth rate from 2008 to 2012. That's 12.6 times faster than GDP growth during that same period. In fact, I'm sure many of you on the line remember, but average dealership earnings returned to pre-recession earnings levels by 2009, which is really pretty incredible. As difficult as March and April has been for new vehicle sales and for our industry, Wall Street has quickly refreshed its memory of how auto retail performed after the Great Recession, switching from an extreme pessimistic view to an optimistic outlook in short order. Since bottoming on March 18th, the Kerrigan index has risen an incredible 81%, outperforming the S&P 500 by 25%. And while the economic impact of COVID-19 is, of course, different from the Great Recession in many ways, for the most part, investors are realizing that these differences are to the benefit of the auto retail industry. For instance, unlike the adversarial relationship between many OEMs and dealers in the 2008-09 recession, when COVID hit, OEMs, as well as many industry vendors, lenders, and partners, provided dealers with tremendous support to ensure they could weather the financial impact of lost sales and shutdowns. Roger Penske noted this support in his first quarter earnings call, as did most of the other public CEOs. In addition, of course, the Federal Reserve and the federal government moved at an incredible pace, a much faster pace than they did in the last recession, to ensure the credit markets continued to function and businesses could stay afloat. This may be the very most important difference of all between the Great Recession and what we're dealing with today. And it is probably the main reason we are seeing such a strong rebound in car sales in May and June. Within the first week of realizing the U.S. would undergo massive economic shutdowns, the Fed embarked upon programs to provide, quote unquote, whatever it takes liquidity to all facets of the U.S. financial system, increasing the size of its balance sheet by $1.5 trillion in a matter of days. Congress also moved at a record pace, something that I'm sure most of the AIADA folks didn't think was possible, passing the CARES Act, which included, of course, critical PPP funds to ensure businesses had an economic cushion to weather the crisis. The combined actions of the Fed and the federal government infused trillions of dollars into the U.S. economy in the shortest period in history. And we believe is the primary reason we have seen very few distressed dealership sales, even with such a dramatic decline in auto sales and earnings. Of course, the Fed also dropped interest rates by 100 basis points on March 15th. We all know that auto sales are the most interest rate sensitive retail industry in the U.S. When interest rates are low, as they were, of course, as we came out of the Great Recession, auto sales usually rise. And we expect the same to occur this time around. Lower interest rates also result in a lower cost of capital for buyers of dealerships. As auto retail sales rebound, Kerrigan Advisors expects we could actually see blue sky values rise above pre-COVID levels. After all, the lower a buyer's cost of capital, usually the lower their return expectations and the higher the multiple they can pay. And we saw this exact situation last year. As interest rates declined throughout the year, average blue sky values rose. We expect we could experience the same scenario as the economy reopens in the second half of 2020, and buyers once again tap into even lower cost financing. Ryan Kerrigan will go into more detail about how to think about valuations in light of COVID-19. So in the meantime, I'm going to discuss 3 trends we are monitoring in this dynamic market as the second quarter comes to a close. The first trend we are tracking may surprise some of you. It certainly surprised us a bit. And that is a surge in buyer and investor demand for auto dealerships. As the shutdown got underway in late March, our phone really started ringing. We started to receive an unprecedented number of calls from buyers and deep-pocketed investors, some of whom were new to auto retail. We had never spoken to them before. And this was, by the way, coming off of 2019, when we had already received a record number of interest calls and had a record number of conversations with new investor firms seeking to get into auto retail. Now, of course, some of these buyers that we spoke with were seeking to bottom feed and wanted to know if we knew of any distressed transactions. But we would say that really was the minority of these conversations. For the most part, the acquirers that called were letting us know that they felt the time had come to commit significant capital to auto retail. Some of them shared with us that they had been on the sidelines for several years, watching the industry, but hesitant to make big bets when auto retail was in an extended sales plateau and earnings growth did seem difficult to achieve. However, with 2020's abrupt correction in auto sales due to COVID-19, these buyers and investors now see a tremendous growth opportunity ahead, not only for car sales, but also for earnings. After all, we all know on the line, the industry is now operating at a much more efficient level with fewer employees as a whole, and buyers believe that scale will enhance margins, making today a highly attractive time to be an industry consolidator. These outside investors and large dealership groups also tend to have outsized access to low-cost financing for acquisitions. With a lower cost of capital, these companies are better positioned to meet sellers' pricing expectations and complete large transformative acquisitions, as many of them have been doing for the last 5 years. You can see on this graph, Kerrigan Advisors analyzed the top 100 dealership groups with outside capital partners. And these, in our estimation, have grown their dealership count by 125% since 2014, and they're not going to stop anytime soon. These growing groups expect the buy-sell market of 2020 and 2021 to favor the largest well-capitalized consolidators. Many of these companies have successfully navigated the crisis with a high level of cash on hand and tremendous access to capital. As sales rebound, these companies will seek accretive acquisitions where they can employ new low-cost savings and digital retailing to further enhance profits and increase their acquisition returns. Notably, in the first quarter, despite COVID-19, the number of multi-dealership transactions hit a record level, with 15 completed in the quarter, representing 31% of the deals. This to us is a further indication of the demand for larger transactions, and we expect that will continue as we see the buy-sell activity rebound. And we also expect that trend will continue, particularly because the publics are re-entering the buy-sell market. Many of them have seen their valuation multiples rebound significantly since their March bottom, making acquisitions once again accretive to earnings. This brings us to the second trend that we noted in our Blue Sky report, which is that we think buy-sell activity will rebound quicker in some markets than others. While certain states mandated the closure of all retail sales, others deemed auto retail essential. As a result, and you can see on this map, the impact on industry sales was highly dependent on geography and state regulations. By way of example, while Utah and Arkansas didn't have significant stay-at-home orders, those two states were minimally impacted by the shutdowns that we saw in other states in April. By contrast, you have Pennsylvania and Washington that saw their sales decline quite significantly, 75% in Pennsylvania and 68% in Washington. As buy-sell activity re-engages in the second half of 2020, Kerrigan Advisors expect states that were minimally impacted by COVID-19 to have a higher level of activity than states or regions where the economic impact has been meaningfully negative. We're finding that the Mid-Atlantic, the Southeast, Texas, and some of the mountain states are experiencing the highest demand currently, as one of the regions that, of course, were least impacted by the virus. So, of course, all of this could change if we experience a second wave of cases. And in that category, we are not experts. But this is something that we do think will drive a lot of the activity levels as we reopen the economy in the second half of the year. The final trend that I'd like to discuss is real estate, which, as many of you know, tends to be the most valuable asset on most dealers' balance sheets. In the first quarter of 2020, commercial real estate values declined an estimated 10% due to the economic shutdown. Now, this decline could be temporary given the recent reduction in interest rates, which typically results in asset inflation. However, there are dynamics at play in today's commercial real estate market that may offset the benefits of a low interest rate environment. In particular, closure of retailers, restaurants, and entertainment venues due to COVID-19 could result in a sharp rise in property vacancies, which may lead to further reductions in property values. It should be noted that retail store closures had actually already spiked sharply before COVID due to consumers shifting preferences to digital retailing. In fact, in 2019, we saw a 34% rise in store closures, and that was before we had the economic shutdown. While dealership real estate prices have almost doubled since 2009, leaving most dealers with a tremendous amount of equity in their real estate, prices have started to decline slightly. They declined in 2019 by about 2% by our analysis, and this may be due to some of those rising vacancies that we've been seeing in retail real estate. And while a decline in dealership real estate values is potentially negative for sellers, although again, I'll point out that real estate prices have risen quite considerably, moderating real estate values could be a benefit for the whole industry due to lower rent factors, which we do believe is critical to the industry's financial health and future success. Prior to the pandemic, OEM facility demands were becoming less and less economic in an era of compressed new vehicle gross profit. When the recent increase in digital sales caused by, of course, COVID-19, with that increase, OEMs are in some cases postponing their image program deadlines and refocusing dealers' capital toward vehicle sales and investments in digital retailing rather than bricks and mortar. This is particularly important as rent per new vehicle sold skyrocketed to an unprecedented level in March and April, highlighting the risks associated with a high fixed expense structure. To close out this discussion on real estate and to tee up Ryan's review of franchise buy-sell activity and valuation, one interesting observation is the differing levels of rent based on type of franchise. As you can see, rent and rent to gross profit is higher for most import and luxury franchises due to the level of finish required of these facilities, which tends to be very expensive. For this reason, the weaker import and luxury franchises command lower blue sky multiples because their low sales per franchise really do not support high real estate expense and thus diminishes their blue sky value. These dealers may get full value for their real estate, but often that means much lower value for their blue sky. By contrast, domestic franchises benefit from lower average rent and less expensive facility requirements. With that, I am going to turn the presentation over to Ryan, who will review specific franchise buy-sell activity during the quarter and discuss how COVID-19 is affecting blue sky values and how we should apply blue sky multiples.
Great. Thank you, Erin. Clearly, many of those calling in today want to understand how the pandemic and shutdown have affected blue sky values and multiples. So we're going to start with a review of what franchises transacted in the first quarter. In reviewing the data for the first quarter, domestics continue to dominate the buy-sell market, representing 57% of buy-sells, up a remarkable 84% over the last 5 years. We believe this uptick in transactions has both a specific buyer and seller component. Buyers are attracted to the return on investment, ROI, of domestic franchises, given their lower blue sky multiples, less expensive real estate, and highly profitable truck sales. And we see this trend continuing. From a seller perspective, domestic franchises now command strong valuations, and many families have simply reached the end of their succession plans, often spanning several generations. As such, many have decided it's time to sell. The recent push towards digital retailing and new ways of managing dealerships will only accelerate this trend. We noted that import luxuries buy-sell market share increased a bit in the first quarter of 2020 to 18%. Here, buyers are paying more, but like the high UIO counts and strong fixed operations associated with many luxury franchises. And this low interest rate environment has facilitated the ability to pay up for higher multiple deals. And here's how the buy-sell market played out in terms of specific brands in Q1. As you can see, Chevrolet and CJDR really dominated the buy-sell market in the first quarter, while Ford buy-sells trailed considerably. GM earned some very positive headlines by posting strong profits, even through the tumultuous COVID period, while Ford entered this recent economic disruption in the middle of a very significant internal restructuring, and has since reported very large losses, leading some to have some real concerns about the near-term future of Ford. Of note, Lexus was the 7th most traded franchise in the buy-sell market in the first quarter, representing 5% of the market. In the last 18 months, we've had the pleasure of representing on the sale of 5 Lexus franchises, and we observed that many long-standing dealers are deciding that now is the right time to sell. Franchise values are exceedingly high for that brand, and there's very, very strong buyer demand. As Erin mentioned earlier, we're seeing a significant rise in buyer interest, sparked by the strength of the auto retail business model against the backdrop of this unprecedented COVID shutdown. But as with most economic crises, there's been a real flight to quality, resulting in a disparity in pricing power. Excluding opportunistic buyers who are looking for quote-unquote deals, we've seen the buyer pool further emphasizing top brands and high-quality locations, giving those dealerships an edge in pricing relative to franchises with lower sales per rooftop. With that understanding, we also believe the factors that drive multiples up and down may shift post-crisis, with some having greater effect and others having less. Specifically, as the buy-sell market reopens for business, we believe earnings growth expectations, buyer demand, and revenue mix will have the biggest impact on blue sky multiples and what buyers are willing to pay. Buyer demand will have a strong impact on multiples as various regions of the U.S. respond more quickly post-crisis. Thus far, the Southeast, Texas, the Mid-Atlantic, and the Mountain States have all fared better and rebounded more quickly than other parts of the country. Revenue mix will be very important to buyers as well. We expect dealerships with historically high and consistent fixed operations to receive higher multiples post-crisis, as their earnings will likely rebound more quickly than those dealerships that are heavily reliant on new vehicle sales. And one note regarding real estate. We believe that we may have a window where facility requirements become less of a deal point post-crisis as OEMs back off facility requirement demands and instead focus on reopening sales departments and selling cars. This will be a positive for the buy-sell market in 2020 and likely into 2021. OEM de-emphasis on larger and image-compliant facilities is consistent with what we saw after the credit crisis a decade ago. While we did not go into detail on all 7 factors today, these are all critical components and influence what multiples buyers are willing to pay for any given store. The question on everyone's mind is, what should that multiple be applied to? Not surprisingly, most sellers will not accept a multiple on trailing 12 months earnings, including the economic shutdown, particularly given the dramatic declines experienced in March and April. In our view, and in a view shared by most dealers, this one-time phenomenon does not provide much insight into the valuation of these businesses. Much like the effects of a natural disaster, Kerrigan Advisors is treating this period as a one-time event. Thus, we expect most dealerships to be valued based on adjusted pre-tax earnings pre-COVID-19 and expected future earnings as the economy reopens, effectively removing this period of disruption from the valuation equation. Notably, of the 14 transactions Lithia currently has under contract, the company has chosen not to adjust blue sky pricing due to the immediate financial impact of the coronavirus. Rather, Lithia will monitor the seller's earnings rebound to determine if a future price adjustment may be warranted if the dealerships do not track back to 90 to 95% of pre-pandemic levels. It should be noted that these dealers who are considering the sale before COVID-19 are, in our experience, even more seriously planning their exit once the buy-sell market reopens in the second half of 2020. Many of these sellers are at the point of retirement and have been contemplating a sale for some time. For this reason, Kerrigan Advisors expects a continued steady stream of sellers coming to market over the next several years. To review the specific blue sky multiples for the first quarter, we want to emphasize that we see a lot of stability in valuation. That said, we did make some changes in our first quarter blue sky report, specifically 4 changes to blue sky multiples, 1 upgrade, and 3 downgrades. We upgraded Toyota's low-end multiple from 5.25 to 5.5. This increase reflects rising buyer demand for one of the highest quality franchises in the industry. Buyers believe Toyota is best prepared amongst all OEMs to weather the economic impact of COVID-19. Not surprisingly, Toyota had one of the lowest sales declines in the first quarter of any franchise and maintains the highest credit rating of the OEMs. With a flight to quality assets, Toyota franchises are expected to command even higher multiples as buyers seek safe investments during the pandemic. Kerrigan Advisors downgraded Ford's low-end blue sky multiple from 3.75 to 3.5. The reduction in Ford's low-end multiple comes after the company reported a $2 billion loss in the first quarter and planned delays in new product offerings, especially the Ford Bronco. As I mentioned earlier, we're seeing buyers getting wary of Ford's management's decision-making, as well as its weakened financial position going into the pandemic. Ford's bond rating was recently downgraded by Moody's, moving one step closer to non-investment grade status, increasing the company's cost of capital and limiting its ability to raise funds. Kerrigan Advisors also downgraded Buick GMC's high-end and low-end multiples to 3.5 and 2.5 respectively. In an uncertain economic environment, Buick GMC's low car sales per franchise will make profitability even more challenging. And finally, we reduced Nissan's blue sky multiple on the high end and low end to 3.25 to 2.25, respectively. Nissan sales plummeted 30% in the first quarter, despite strong industry sales in January and February. Continued management turnover and uncertainty has many dealers concerned and buyers less willing to step up for this franchise. That said, we do see a lot of Nissan dealerships for sale, so we could see an uptick in buy-sell activity, though at very low multiples. Our annual Blue Sky report goes into great detail on each of these franchises, including a review of their product pipeline, product quality, customer retention, and buyer demand. So we will not do a full review of all of that today. One item that we called your attention, however, post-COVID is credit quality. The pandemic impacted OEMs differently, and this will have real, lasting impact on the balance sheet health of some OEMs. In recent months, Toyota, Honda, Ford, and Nissan all experienced credit rating declines. In the event that there's a continuing trend, these downgrades will undermine OEMs' ability to invest in product development as well as navigate the massive investments required for electrification. For the luxury franchises, we again emphasize strong valuations and stability in multiples and valuation. We've made no changes to luxury blue sky multiples in the last quarter. In the luxury market, we'll continue to see the have-not market share structure. The top brands have sufficient volume and gross margin to make their franchises highly profitable and consistently profitable. The have-nots fundamentally struggle with unit volume per franchise, and that's likely to be even more true as we see overall SAR down for at least some period of time. As you may have noted, last quarter, we initiated the coverage of Lincoln as we're starting to see a broader product line there, which has been very well received, and more standalone image compliance stores. Here again, we think the real update in recent months is balance sheet strength. For the most part, the dominant German and Japanese brands are in relatively good shape, though economic disruption will put a much smaller Jaguar Land Rover business model at more risk relative to its peers in our estimation. Many Land Rover stores represent industry-leading profitability today in the United States, but those dealerships are highly reliant on small volume and very high gross margin products. And many other OEMs are squarely focused on competing in Land Rover's highly profitable market niche of luxury SUVs. All of this brings us to the summary of our high-level perspective on economic activity and the buy-sell market for the remainder of 2020. Automotive retail has bounced back more quickly than many anticipated, and we have seen deal activity bounce back more quickly than we anticipated. In March, we guided our clients that we believe the best case scenario was having meaningful negotiations in the July timeframe. We are happy to report that we are in conversation and in some cases real negotiation in the first half of June on some sizable transactions and expect to see increased deal announcements in late Q3 and early Q4 of this year. We can say with a high level of confidence that deal activity is back on track and valuations are very reflective of pre-COVID levels. Interestingly, this economic disaster and the stresses on automotive have served to underline just how resilient automotive retail is. Even with the ultimate curveball thrown at us in 2020, this will end up being a very solid year for our industry, for valuations, and for buy-sell activity. I'll turn it back over to Erin to wrap it up today.
Thank you all for joining our webinar today, and thank you AIADA for hosting us. We do hope you found the information we have provided helpful to your business, whether you are planning for growth or considering an exit. There is no doubt in anyone's mind that this pandemic is one for the history books. While we do not know for sure if we will be celebrating in person or via Zoom, I hope not via Zoom, at the NADA in 2021 in New Orleans, we are quite confident that by January, dealerships will have much to celebrate wherever that celebration occurs. Thank you very much, and we'll now open it up to questions that Ryan and I will take. So if you do have any questions, please type them in to the question box, and I think there's one that we have so far. Ryan, do you want to start off?
Sure. And we've actually got a couple questions coming in as it relates to PPP monies and how dealers are taking PPP money into P&Ls and whether or not that gets translated into profitability and calculations of valuation.
Sure, I'll take that one. So our view, as we mentioned, that this period during shutdown during COVID-19, when we really did see an economic shutdown, we do not believe those months will be part of the earnings calculations when looking at a valuation of a dealership. And that's both ways in terms of the negative and the positive. So PPP monies, in our view, are one-time funds coming in and would not be part of the valuation equation, nor would, of course, the period of lost sales and lost earnings. So that's our view. I don't think any buyer would expect more PPP funds in the future, so I don't think you can look at PPP funds as something that would be ongoing. Okay, another question we have here is, what type of investors are seeking to get into auto retail? And are they buying into existing dealer groups, or are they hiring management teams, or maybe backing an existing dealer? Ryan, you want to take that one?
Yeah, and so investors come in all kinds of stripes. As we have said many times, the investors that are really best positioned to make investments in automotive retail are really family offices, and that's for two reasons. One, family offices can choose to have mandates where they're evergreen investors. They can invest for very long periods of time, and they can also work around the governance issues required in automotive retail. And so we really see family offices being the most likely to do significant investments, and they very much prefer to invest in existing groups. It's harder. I'll state it the other way. It's easier for them to wrap their arms around an existing group, an existing culture, and make a significant investment versus backing a manager. There are other forms. It's not to say that all these deals are done in one way, but I'd say that the bias is towards investing into an existing structure.
I just add that we do have examples in the industry that we've seen where oftentimes second generation dealers are know the business, love their family, but have decided that rather than grow a group with their family's balance sheet, they'd love to enjoy Thanksgiving and instead work with an outside capital partner. So we do see some existing second generation dealers partnering up with family offices that are not their family to grow groups, and that also seems to be something we are seeing in the marketplace as well. Let's see, is there another question coming in here?
Yes. When do you see large platform transactions closing again?
That's an interesting one. You know, I actually, much again to our surprise, when we were in the midst of the shutdown, I do think you're going to start to see pretty transformative transactions occur and get announced maybe as soon as the fourth quarter. And I think 2021 could be a monumental year for very significant transactions, similar to the transaction that was announced but did not close in Asbury's acquisition of Park Place dealerships. And let's see, we have one more here.
There's a question about, so there's a lot of discussion in automotive retail about inventory concerns.
Yeah.
We have talked with many dealers. GM comes up in many conversations about concerns about inventory coming up. Toyota in some cases, Honda in others. And so the question is, how does this impact franchise valuations? And, you know, our sense is that two things are going to happen. One, that there are in fact going to be dealerships that are going to struggle with their unit volume projections for lack of inventory. And frankly, our hope is that that's going to be offset by increased margins on those sales. And so I guess, you know, for the purpose of those of us in the buy-sell world, it'd be great if those two things offset each other and we saw earnings stability. But, you know, there could be a scenario where we see earnings down in individual stores for reasons just a lack of inventory. That will be sort of a one-time issue. It'll be a trailing COVID issue. And we'll simply have to make the case that is just not you know, sort of a intrinsic part of the business, but just a one-time phenomenon.
Yeah, and I would add just, you know, you've already seen the OEMs talk about getting rid of their downtime in the summer. And OEMs are in the business of manufacturing vehicles, so they are going to work like crazy to fill that supply gap, and I expect they will do so in as shorter order as they can. Again, assuming we don't have some sort of big wave of cases that we weren't expecting. There's also a question here that I think this may be our last question. I want to let everyone go back to their day jobs, but we did have a question here about how the trends we're talking about, are they the same as in the U.S. as in Canada? We do have an experience as a firm in Canada. We've sold quite a few dealerships to Canadian buyers and have done some transactions in Canada. I mean, I would say that many of the trends are quite similar. I know that Canadian real estate prices had risen to incredible levels. I would expect you may see some of those values decline a bit. So that trend I would see. In terms of surging buyer demand, that we have not seen a huge surge in buyer demand for Canadian dealerships. What we continue to hear is Canadian dealerships are very high priced, even relative to U.S. dealerships, and that's part of the reason you're seeing so many Canadian buyers come down to the U.S. Plus, in the U.S., we have really attractive franchise laws that provide much more protection to your investment than you get in Canada. So I would say in that regard, the surge in buyer demand would not be. We haven't seen that in surge in buyer demand for Canadian dealerships.
If we can maybe take time for one additional question, an interesting one, and that is, how can a seller avoid getting into the situation of Park Place, and then which the deal was announced, it was completely public. Obviously, all those kind of HR and culture conversations had to happen, and then ultimately didn't go through. And that is kind of a seller's nightmare, and just a really unique, sort of outcome of COVID. I'd say that for most transactions where they're not so big that even if it's a publicly traded company, that certain announcements have to be made in advance, we always very strongly counsel that going in for OEM approval and then ultimately telling the staff does not happen until all of the diligence has been done. And so it can draw out the overall timeline a little bit. But the idea is that no public announcements are being made, and you're not having to inform the staff until days or at most maybe a couple of weeks before close, trying to absolutely minimize that risk in a transaction. And knock wood, I'm happy to say we have not ever had that happen in any of our transactions, but that's probably because of the very careful way that we sequence the events. But an interesting question.
Yeah, I would just say, obviously, no one could have predicted COVID-19, so there's parts of that would have not been able to, you couldn't have avoided, because it was the 100-year event that you never think about happening. But I would say in that transaction, another thing to make sure there's no finance contingency on the buyer's side, because if the buyer can terminate transaction because they don't have their financing, then you do run that risk if some unforeseen occurrence happens in the marketplace. I actually think in that case, there was a sizable breakup fee that the seller did receive, probably not what they were looking for, but nonetheless, they did get a pretty sizable amount of money because the transaction terminated. But nonetheless, it's important to make sure that you don't have a finance contingency, that the buyer doesn't have one, because that does expose you to risk of your deal not closing and having it exposed in the marketplace, which is, of course, what no one wants in their transactions. Well, thank you again, AIADA, for inviting Ryan and I to present to the membership. We really do value our relationship with your organization and believe what you do is so critical to the dealers we work with and the industry. So keep up the great work, and we hope that we'll get to see all of you in person in the near future.
Great. Thank you all, and thanks again to the AIADA team for putting this together.
Aaron and Ryan, thank you for coming and speaking with us today. This is really great information for our members and our non-members to be aware of. If any of you submitted questions that did not get answered because of time, I will be sure to forward them over to Erin and Ryan for you. And again, to those on the line, you will be receiving a recording of this webinar by the end of this week. To continue our COVID-19 webinar series, join us back here on Thursday, July 9th at 2 p.m. Eastern as Charlie Chesbrough, Senior Economist at Cox Automotive, returns to update us on the month of June. Be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org. Thanks for joining us and have a great day, everyone.